There was something in the water in the late 1960s flowing south down the Chicago River, making its way into the pipes at the University of Chicago's Business School. It awakened a curiosity about the nascent power of computing, data analysis, and the way capital markets worked. A legion of Nobel Prize winners came out of that department. Many of them reshaped the way we think about the economy, the markets, and our behavior in those ecosystems. Milton Friedman, George Stigler, Gary Becker, Harry Markowitz, Myron Scholes, Eugene Fama, a financial murderer's row of the most revolutionary thinkers in modern financial history, all came through the hallowed halls along South Woodland Avenue, as did David Booth, a Lawrence, Kansas kid trying to make it as a shoe salesman, but knowing he had a higher calling. And that calling eventually led him to found Dimensional 43 years ago, an investment and advisory firm that today boasts $770 billion in assets under management with over 1,500 employees around the world, but just one investment philosophy. And we're delighted to be joined today by David Booth, the chairman of Dimensional, and for whom the University of Chicago's Booth School of Business is named for, thanks to his generous donation. Thanks so much for joining us.
Oh, well, thanks for having me. I've looked forward to this.
Yeah, what a ride. What was going on in Chicago? Obviously, the university, especially the business school, wanted to attract smart thinkers, but they were on the verge of something that nobody was aware of.
Well, no, that's right. And you're correct to point out, it's all of a sudden they had data, and they had computers big enough to process the data. I mean, because even though you have data, if you're trying to do a regression on a HP 12C, pretty tough to do.
How big were the rooms, though, for these computers? They were entire rooms at the time. They were mainframes.
Yeah, I mean, there's buildings. Yeah, right. They were. It was very difficult to get turnaround on your programming. So you'd spend all night down at the computer center.
Yeah, load up the chips, come back in the morning. Hopefully your data came out. But in that, you had some very interesting people like Eugene Fama, like Myron Scholes, like a lot of these people who were fascinated with data, but also they didn't just take Wall Street's word for gospel, right? They said there's something very wrong and very different about what's going on in finance than what the guys on Wall Street with the suspenders and the cigars and the martinis are telling you. They think they know it all, but they don't. Why did that curiosity spark up in people like Eugene Fama and others?
Well, I mean, you described it pretty well. The way I think of it is, and talking to people, a lot of people think that the stock market is run by insiders, and then they feel like they're an outsider, and so they're not really part of the game, and they don't invest. And I think the breakthrough in a nutshell was these insiders weren't as clever as they claimed to be. And a bunch of these outsiders, Fama, Scholes, Miller, and the group, tested what they claimed and found it to be wanting,
And the key thing that they were really testing, the core of it all, was the information about the market is contained in the market. Pricing data will tell you everything. Pricing trends will tell you a lot, but it's not as if somebody has the next hot thing because somebody told them over at the bar that that's why that stock's going to go up. What was the importance of testing that theory?
I guess in essence, as you're saying, you may be smart, but the market's smarter than you are. So people just looked at the data. You look at the performance of professionally managed portfolios, for example, is largely in the public domain. You could test it out now. And after fees are considered, the results are worse than you'd expect by chance, that's difficult to explain. It just means basically the costs of doing all that trading and so forth and management fees, wiped out any advantage that they thought they had.
Yeah. Meanwhile, Jack Bogle was also figuring that out as well. And he went on to become sort of the godfather of index fund. But it was also this questioning that you eventually walked into when you went in there as a PhD student. What does right mean? Risk versus expected return. Why did that become something that you wanted to tackle yourself?
Well, I think the whole motivation of these great academics was to really understand more about markets and how they work. And if they could do that, then they could improve, the lives of a lot of people, help people figure out a better way to invest. And that's what happened. Over the last 50 years, things have changed a lot. People are getting a much better deal in investing today than in 1971 when I started out. Fees are lower, better risk controls, and so forth. Flowed from these ideas and all this research that was being developed.
Right. And it also opened the capital markets because all of a sudden, real normal people were like, wait a second, if I can just bet on the index, if I can just invest in the index or pick a sector, I can outperform what hotshot thinks down on Wall Street?
Yeah, pretty cool, huh? It's the democratization of investing. There's, and that's part of the motivation that we have in doing our documentary, is that we want to help people learn more about how markets work. And if they learn more about how markets work, they're more likely to invest and have a good investment experience over time.
Yeah, I want to get into the documentary in a minute, but you've engaged the Academy Award-winning filmmaker Errol Morris to make a film called Tune Out the Noise, which is incredible, folks. We'll link to it in the show notes, which Errol Morris is one of the best documentary makers of the last 50 years. This documentary is beautiful. I want to talk about why you wanted to tell the story more in a little bit, but let's go through the timeline of kind of what you walked into when you went to the University of Chicago as a PhD student. 1964, William Sharps develops the capital asset pricing model, right? A method for evaluating the expected return and risk of securities and portfolios. That's seminal. 1965, Fama, your colleague, Eugene Fama, the historic financial analyst journal paper Random Walks in Stock Market Prices, right? We also know about Random Walks down Wall Street. 1969, you enroll in the University of Chicago as a PhD student. Right around all this idea formation, all this data analysis, what hooked you? Why did you want to get into it in the first place?
I was always curious about finance, and I had to do something with numbers. My undergraduate and master's degrees were in quantitative things, and all of a sudden, particularly at the University of Chicago, all of this research data, quantitative aspects were very appealing to me. Now, how I got hooked was really early on, sitting down. My first day was a course taught by Eugene Fama, and he quickly got into this notion of how markets work. And I go, that has to be the way markets work. And it wasn't until much later I realized that Wall Street didn't believe any of that. But it turns out Fama was right. So Fama 1, Wall Street 0,
Yeah, and he had no problem sticking his finger in the eye of Wall Street. He was an outsider, came from Massachusetts. He was a tough kid. He didn't know business being there in the first place. You were a shoe salesman and decided that you didn't want to be in a profession where you didn't feel great about what you were doing. What made you go, this is not for me, but this definitely could be for me?
Well, it's all about, at the end of the day, I think people want to feel good at the end of their careers that they helped. The world was better for them having been there. And so my idea was, I'll go get a PhD, return maybe to Kansas and be a professor, And that was it, because I thought that would be have a lot of satisfaction in that.
Yeah, you could do a lot worse than that. Plus, you had a fun team to root for. But cut to 1981, you're founding Dimensional just about a mile or two from here in your Brooklyn brownstone.
Right.
How did you pull it all together to form the firm?
Well, a lot of things came together. I think Friedman, I heard him once use the term economic syzygy. Syzygy is where three planets come together in a row, and when that happens, astrologists say, cats will start sleeping with dogs and so forth. And
end of days.
A lot of things had to come together, but basically, the aha moment was when we started working with big institutional clients. In those days, they didn't invest in any meaningful way in the stocks of smaller companies. So we go, aha, that's absent from your portfolio, and it's only sensible you'd have stocks of large and small companies. And what we'll do is give you access to small.
Yeah, indeed, you launched in 1981 the U.S. microcap portfolio. That's breaking new ground, offering small caps to retail investors as a diversifying mechanism. Now that's pretty common, but you were the first ones to do it because you had all of this data. And then as the firm continues to grow over time, you keep adding pieces to it, adding new funds to it, adding new dimensions to Dimensional. But when did you realize you were onto something that could become mass market, so to speak, or big enough to attract enough assets to make it a real going concern?
Well, it never really occurred to us. And then we had a financial advisor in Sacramento came in and wanted access to our funds. And we go, we don't know about dealing with individual investors. We think they kind of come in and out and aren't that loyal. And he said, no. We're good long-term investors. So we said, well, we'll give it a try. And he tried it, and then a year later he comes back and says, there are a lot of advisors like me out there that would love to have access to your funds. And so that's how we started working with financial advisors, and now that's a bigger part of our business.
It's a huge part of your business. They're recommending those funds to people like me. In 2021, you become the largest active ETF issuer after launching ETFs just in 2020. So that was quick. You were definitely onto something, and it's evolved since then. So this is all built on data. Numbers don't lie. This is how you built the firm. Evidence-based investing, really at its core. Fast forward to 2025, David. Today, the age of AI, data is the currency of the 21st century. What has this meant for Dimensional? What has that meant for portfolio construction and management overall?
Well, it makes the whole process more efficient. There are things that AI is going to be able to do that'll make life a lot easier for us. Often the question kind of goes, well, does this mean that people will be able to pick stocks more easily now than they could in the past because of AI? And I think the answer to that is no. I mean, this whole notion of market efficiency, as coined by Fama, says, the best evidence is the market reflects all available information. No matter how big the AI machine is or algorithm, it doesn't have access to all available information.